Very good morning, everyone. Welcome back to today's session on international business economics. Uh, in this particular concept or in this particular session, we are going to start and deal with the respective trade theories. Going with the what we have seen in the earlier sessions. In the earlier sessions, we have seen with the concept of respective trade agreements. So, what are the various respective trade agreements with respect to which we have seen what are the different types of trade agreements in which a agreement can be signed between different countries in order to conduct the international business activity. The trade agreements can be of different perspectives or types, which may be either a multilateral trade agreement, unilateral trade agreement, bilateral trade agreement, or a plurilateral trade agreement. In this way, different trade agreements can be entered by different nations or different countries, and accordingly, the trade agreement can be signed, and the business or the international business specific to be can be conducted with different nations. Now, going with the concept of again, just recap of what we have seen or undertaken in this particular concern. The free trade refers to a situation where a government does not attempt to restrict what its citizens can buy from another country or what they want to sell to the another country. So, in terms of free trade economy, what is the major concept or understanding? That the government is not restricting or the government is providing a free trade economy, a freedom wherein you can buy and sell the products of a desired country, whichever it may be. For example, if you want to import certain goods and services from US or Europe, the government is providing a platform for it and a market is open. And in another sense, if you want to export or sell the certain goods, your manufactured goods to some another countries in either in Europe or Japan or France or Russia or Italy or China, then that particular feasibility or option is also made available, wherein you can go and sell your product in the international market, in the global market, or the overseas markets also. So buying and selling of goods and services at the international level, global level, is possible with the help of free trade. And this particular free trade conduction of transactions in the international economy is called as an international business transaction. While many nations are nominally committed to free trade, they tend to intervene international trade to protect the interest of political important groups. So it has been found out that there are certain types of nations who very rarely participate in the international business transactions or go for the international trade transactions. So at this point of time, what happened with the involvement of various political intervention, with the intervention of the government agencies, the import and export of goods and services, the international trade transactions are conducted freely. So at this point of time, when there is a government intervention into picture, there is a proper control on all the environmental factors, all the social, cultural, political, pastoral, all the political, economic, social, technological, analytical, and legal factors, and it is found a controlled environment. So in this way, the nations have been conducting their business activities and the government supports for this particular concern or the cause of conducting the international business transactions. Now, we have also dealt with what are the various instruments of trade policy. Just to give you an overview about what we have seen in the last lecture, I'm just briefing you or summarizing these aspects. The first thing, question, why do government intervene in the international trade? So, why there is a need that the government wants to intervene in the international trade? We are going to see with it in detail. There are various 7 main instruments of trade policy. So whenever these particular instruments in trade policy, which we have already studied in last lecture, whenever this particular concept or concern comes into picture, what happens? There is a certain possibility or a certain situation wherein a price may go up, a price may go down, the demand may rise, the demand may fall, the supply may be productive, the supply may be, the goods may be productive, unproductive, or defective, or what it may be. So various terms and conditions, various issues may arise at a national level or international level. So in order to control all these particular issues, there is a need of intervention of the government perspectives. Now, coming back to the 7 main instruments of the trade policy, which we have already studied, those were the tariffs, the subsidies, the import quotas, the voluntary export restraint, the local content requirement, the anti-dumping policies, and last, the 7, that is the administrative policies. Now, in terms of tariff, we have seen a tariff is a tax levied on the imports that effectively raises the cost of imported products related to the domestic products. So, specific with respect to the 2 types of taxes we have seen, it is called as a specific tariff and ad valorem tariff. So what is a tariff? Any amount that is being charged by a respective government in form of tax whenever you are importing certain goods and services into your own country. So for import of goods and services from some another country or the international or the foreign country, the government is charging a certain amount of tax, and that particular tax is called as a tariff in international terms. The tariff is of majorly classified in two types. The first thing is the specific tariff, and the second one is the ad valorem tariff. Specific tariff are levied as a fixed charge for each unit of goods that you are importing. So, based on the fixed product's price, based on the fixed quantity or the unit of a particular product, the amount of tariff or the tax is being charged by the respective government. For example, if you are importing a certain goods and services of a certain fixed quantity. That is, if the government is giving a certain limitation to import the goods and services of a certain quantity, for example, 100, 200, 500 or 1000, then at this particular point of time, up to 1000, no tax will be charged for you. So at this point of time, whenever you are importing the certain goods and services, the government will charge only specific tariff with respect to 1000 goods and services. So for example, if you are importing chairs, if you are importing furniture, if you are importing gold, if you are importing diamonds, if you are importing certain cell phones or a certain technological product, digital products, or whatever it may be. Now, whenever you are importing certain types of goods and services up to 1000 quantity, there will be a specific charge rate, that will be a specific tariff that the government will be imposing you, and which will be either 2%, 3%, 5%, depending on goods and services. It differs from product to product, services to services, and goods to goods. Now, second perspective is the ad valorem tariff. Ad valorem tariff are levied as a proportion of the value of the imported goods. So, based on the valuation of the particular goods and services, the government is imposing this particular type of tariff. Now, the proposition or the proportion of value. Now, for example, if your proportion or the value of the goods and services goes above this particular limit. Now, if a particular limit has been provided that for importing a certain quantity, so importing a certain raw material or importing a certain goods, the limit or the proposition that was been provided is, or the maximum subsidiable limit is up to rupees 50 crores. Now, if your transaction value, if your sales value, if your quotation value, if your invoice value goes above rupees 50 crore, what happened on the above fulfillment amount? That is, on the additional amount of, if your, for example, transaction value is 70 crore, then on additional of 20 crores, the government will charge an additional tariff on you for you. So in this way, for 50 crores, you have to pay separate tariff, that is a specific tariff, whereas on 20 crores, you have to pay ad valorem tariff. So ad valorem tariff is that particular type of tariff, a tariff or a tax that has been charged by the respective government, which has been levied on the proportion of the value of goods imported. So proportion of the goods in the sense, for additional of 20 crore rupees, the government will charge you an additional sum or tax. Now, question, why do government impose tariff, or why do government impose or charge you a certain sum of money in terms of taxes? So tariff, it basically, what is the nature or composition of tax that is being charged? Now, tariff is directly revenue or a resource or a certain income that is being generated for a government. So it automatically or indirectly increases the government's revenue. So for this particular concern, the government is imposing or charging you a certain sum of money in form of tax or in form of tariff. It provides protection to the domestic producers against the foreign competitors by increasing the cost of imported foreign goods. Now, understanding this second concept is most important. Now, why government is imposing you a certain amount or a certain charge of tax on, or a certain amount of tariff? Now, because if, for example, at any point of time, if you are importing the goods and services, what happens? You are not purchasing the goods which are available in your home country or domestic country. For the particular timing, assume if the same product is being produced or manufactured or developed in your own home country or domestic country, you will be tempting to purchase this particular same product in the same your domestic market or the home market, and you will not import the goods and services from the foreign country or the western country. Now, at this point of time, in order to boost your domestic economy or the home economy, the government imposes or charges a certain sum of money in form of tax or in form of tariff, so that you do not import the goods and services and you purchase the goods that have been produced in your home country or domestic currency. The third point, that is, it forces the consumers to pay more for the certain inputs. So if a particular consumer wants a certain qualitative and standardized product, then at this point of time, in order to avail this particular product, in order to use this particular product, the consumer has to pay a certain sum of money in additional basis. So that particular price of this particular product increases automatically, and the consumers have to pay that particular sum of money for importing the goods and services. Tariffs are pro-producer and anti-consumer. So, and in this way, tariffs reduce the overall efficiency of the world economy. So, higher the taxes, higher the tariff, it will be directly impacting the goods and services or the import and export of your transaction services also. So if the tariff is laid at a very higher scale, it may be a certain situation that the consumer may not get the desired product, and it becomes an anti-consumer policy. So it is not favorable for the consumers if the tariffs are being increasing at a very higher stage or a greater stage. Second perspective, now coming with the second important perspective with respect to the instruments of trade policy, is the subsidy. The subsidy is the government payment to a domestic producer. So if a particular, now in terms of your tariff, what we have seen, government is supporting the environment of the domestic production or the domestic manufacturing concern. So if it has been found out, if the same product, same qualitative product is available in the international market, and a particular consumer, if a particular manufacturer wants to produce or manufacture those goods and services in the home market or the domestic market, wherein if a consumer doesn't want to import the goods and services, so what happens if a manufacturer goes for production or manufacturing of those goods and services which are either to be imported, then at this particular point of time, the government provides you a subsidy. So the government is giving you a subsidy to produce this particular product in the domestic market or in the home market, and it is providing you the conducive environment, the supportive environment for production of those goods and services. Subsidies help the government, helps the given by the government to the domestic producers in order to compete against the low cost foreign imports and gain the export market. So at this point of time, both the benefit can be availed by the producer or the manufacturer. First thing is your product becomes competitive, and you can sell your product in the home market or in the domestic market in comparison to the goods that have been imported from the foreign market. And second thing, it is giving you a supportive environment for gaining the export market. So if your product is more qualitative, more competitive, and more standardized according to the international standards, then you can export this particular product. You can export your own produce to the export to the international market also. Next perspective, consumers typically absorb the cost of subsidies. So what happened at this point of time, the consumer is ultimately benefited because the product that is available in the international market, the same product gets available in the local or the domestic market also. So the consumer is indirectly or directly getting benefit out of it, and the cost of subsidy is also benefited to the manufacturer or to the producer. Now, the next perspective we have seen already is the import quotas and the voluntary export restraints. So, the import quota is a direct restriction on the quantity of some goods that may be imported into a country. So, the government may directly restrict a certain goods and services, the quantity of the goods and services that you are importing, and with this particular concern, the import quotas has been claimed and registered by the government. So, a government may register or claim a certain or restrict a certain company to import certain goods and services, and at this particular point of time, if at any point of time, if you want to import certain goods, then at this particular situation, the government may restrict a certain quota. Now, this particular quota means if you want to import a certain cloth, if you want to import a certain chemical, if you want to import certain goods, or if you want to import certain technological products, then the quota can be in terms of quantitative perspective. That is only one quantity, 10 quantities, 100 quantities, 1000 quantity, or 1 ton in so and so on. So in this way, the quotas can be restricted or imposed by the respective government authorities. The tariff rate quotas are a hybrid of a quota and a tariff where a lower tariff is applied to imports within the quota than those to the over the quota. So at this point of time, the tariff rate quota. Now, in terms of tariff rate quota, what happens? The government is imposing a certain taxes. Now, these particular taxes can be in terms of quota perspectives also, wherein the government can give you a certain perspective of feasibility. Your taxation value should be only up to rupees 50 crore. Your taxation value should be only up to rupees 10 lakhs, 50 lakhs, 1 crore, and so on. So in this way, the taxation policy in terms of quota can also be specified, or in terms of quantity, that is 50, 70, 100, 150, 1000, 5000, and so on. So in terms of quantity of the product, or in terms of payment of taxes, that is the monetary value, the quota can be restricted or raised by the government. Voluntary export restraint are the quotas on trade imposed by the exporting country, typically at the request of the importing country's government. So, in terms of voluntary export restraint, the government can impose you a certain restrict, can provide you a certain facility to export the goods and services voluntarily. So, if you are voluntarily exporting these goods and services, the government can either impose the restriction, or the government can either reduce those restrictions. A quota rent is the extra profit that producers make when supply is artificially limited by an import quota. So, if you are producing a particular product in the domestic market or in the home market, so what happens at this point of time? The producer gets an additional benefit. The producer gets an additional supply of these goods and services, and in comparison to the import that you are making of the goods and services from the international market, the subsidy is provided at the domestic market or at the home market. Now, the question may come into your mind that who benefits or who gets benefited from the import quotas and the voluntary export restraint. So the ultimate benefit for the voluntary export restraint or from the import quotas is ultimately to the producers, that is the domestic manufacturer, and ultimately the consumer, because you get the producer or the domestic manufacturer gets the subsidy from the government and the consumer gets the same product availability in the local market or in the domestic market. So at this particular point of time, you can see the benefit from the import quotas and voluntary export restraint is to the both, that is to the manufacturer or the producer and ultimately the end user or the consumer at large. Next perspective with the instruments in trade policy is the local content requirement. A local content requirement demands that some specific fraction of a goods to be produced domestically. So at any point of time, if your company has been registered or in the Indian origin, now at this point of time, what happened? A local content requirement specifically states that whatever may be your transaction, whatever may be your size of business, some portion, some quantity, some limit of your production or manufacturing should be made from your domestic resources or the domestic requirement of production. So if your product has been manufactured or if 100% product has been manufactured, at least 50% or 70% manufacturing must take place in the domestic market and with the help of domestic resources. Remaining 30% or whatever maybe the percentage that has been decided by the government can be raised by the international market or the world market or the global market. So in this way, the government is providing a supportive environment for domestic production of those goods and services. So the requirement can be in terms of physical term or in the terms of valuation terms. So physical terms in the sense that is the quantity of product that you are manufacturing. So if you want to produce 100 quantity, then out of this particular 100 quantity, at least 70 products or the 70% of the raw material must be produced from the domestic market or from the domestic supply that is made available, and remaining 30% can be made from the international transaction or the international supply of goods and services, wherein you can import the amount of raw material that is been required. LCR, that is local content requirement, benefits the domestic producers and creates the jobs at the domestic market. So in this way, it is providing the job and employment opportunities to your local consumers or the local manufacturers also. Administrative policies, we have seen the government intervenes with this particular concern with the help of the political parties, and it creates various administrative policies which sets a certain rules, regulations, and guidelines in terms of your imports and exports of a respective country. So these policies may at times hurt the consumers, but it is always for the superior product and the availability of goods and services at the international market and at the global market. So government is providing a supportive environment in order to produce the goods and services so that the competitive product that is available at the international market, the same product is available at your domestic market also. So in this way, the government is trying to bring a proper balance between the international market and the global or the local market. Next perspective or the concern is with the perspectives of the dumping. Now, dumping is a particular concern wherein if a particular company, if a particular country is manufacturing goods and services at a very larger scale, then at this particular point of time, what happens? The sourcing country or the manufacturing country can dump the respective products in the another country. So in order to control the dumping policy, what happens? The government has to take an intervene at this particular point of time and see that the product is not been dumped into the domestic market, and the indigenous competitors, that is the suppliers, the manufacturers, the distributors, the wholesalers, are not getting affected out of these policies. So the control on the dumping market, the dumping policy with respect to the availability of products in the international market, global market, and world market, as well as the physical composition of the domestic market, needs to be taken into consideration by the government into existence. Next perspective with the anti-dumping policy. Now, in this way, with the help of the administrative policies, what the government does, the government prepares and forms the anti-dumping policies, and it restricts the transaction of goods and services, restricts the import and exports of goods and services, wherein the certain sum of money only can be imported and the certain sum of quantity only can be exported. So in terms of your export and import of goods and services also, the restriction can be placed, the restriction can be imposed on the quantitative and qualitative product of goods and services that can be either exported or either it can be imported. Another perspective is with respect to the countervailing duties. Now, countervailing duty is a certain duty that has been charged by a certain government in order to provide the goods and services wherein it is being charged at a higher rate or at a lower rate. So, the government can charge you a certain sum of money. The government can charge you a certain duty in terms of either the imports or in terms of exports, so as to see that the import and export of goods and services is quite feasible, balanced, and stable at every point of time. Next perspective, now the case for the government intervention. So why the government is intervening in the local market or in the global market? Now we'll be seeing this in detail. The first thing is with respect to the political arguments. Now it has been always found out that there are various political arguments with respect to the certain interest groups. So at this point of time, there is a certain requirement that whether the government should intervene or the government should not intervene. So at this point of time, whenever it is a certain requirement that it has been found out that the environment is not conducive and supportive for the growth of the international trade, then at this particular point of time, there is a certain need that the government has to come up and intervene in the local market, that is the domestic market, and the international market also. With respect to the economic argument, for boosting the overall wealth of the nation, the intervention of the government is being required. So now why this particular intervention in terms of economic is being required? So that the government is seeing a certain perspective with respect to the availability of raw material, availability of goods and services at every point of time. And in this way, the demand and supply perspectives is being matched and a balanced situation is created at an every stage of point or a point of time. The political arguments for the intervention. Now we can see why the government is intervening for a political concern for protecting the jobs of the people or the consumers at the local level. So in order to protect the jobs of the people at the domestic market, the government has to intervene in these particular trade policies. Second thing, protecting the industries that are deemed important for national securities. For certain types of organizations, certain types of industries which are of a deeming to be a national importance. So for protecting those rights, for protecting the demands of these particular industries, for protecting the goods and services, the government has to come forward and intervene into the global market or the international market and the demand and supply of goods and services. Retaliating to unfair foreign competition. So the competition at the international market or the global market, it may directly or indirectly impact your business transactions. And so in order to control all those particular transactions, the government has to come forward and intervene into the global market or the import-export market perspectives, protecting the consumers from the dangerous products. So at this point of time, the particular consumer who is the end user of the products does not know which are the products which have been harmful and which are the products which is been suitable and comfortable for the local consumption or domestic consumption. So at this point of time, what happened? The government, in order to provide you information and identify the type and the nature of the product, the government comes forwards and intervene into the global market, wherein it imposes a certain taxes. There is an in place the various instruments of the trade policy which gives a certain direction about with respect to which product should be imported and which product should be exported, and in what quantity the goods and services can be imported and exported at a certain point of time. It also protects with respect to the furthering the goals of the foreign policy. So in order to decide the foreign policy of a particular nation, the government has to come forward and intervene in the international market or the global market. And lastly, protecting the human rights of an individual in exporting countries. So if you are exporting a certain goods and services, so in order to protect the rights of the human people at the large, wherein who are the recipient of the goods and services, the government comes forwards and intervene into the global market and the international market and provides and sees that a proper feasible environment is being provided accordingly. Next perspective or concern is with respect to the economic arguments for the intervention. So why or what is the benefit of economically by the benefit of the intervention of the government in international trade? First thing, infant industry argument. So it has always been assumed that the industry argument is quite infant and not of a certain position that they are not able to understand about the market forces. So in order to understand the market forces, in order to have a clear picture and understanding about how it has been ruling, what are the various governing factors, the demand and supply, the goods that have been supplied at a very national level and international level, the government comes forwards and provides a certain information with respect to the availability of demand, with respect to availability of supply, with respect to the nature of product, and supporting and creating the environment wherein the industry as a whole can develop and grow accordingly. Next thing, second perspective is with respect to the strategic trade policy. The strategic trade policy needs to be undertaken at a certain point of time wherein the management decision, the government decision, the production decision, the manufacturing decision, the supply decision, the long-term decision with respect to the growth and development of an organization. At every point of time, there may be a certain situation that it is directly or indirectly impacting your business activity. So for this particular concern or the time being, the government has to come forward and intervene in the economic transactions of maintaining a balanced growth of demand and supply, goods and services, and the pricing and the quantity and qualitative products, services. So in this way, the government has to come forward, and the economic argument for intervention with respect to the industry argument and strategic trade policy is much essential required, wherein the intervention of the governments becomes essential or the required. Now, the explanation with respect to infant industry argument is that particular concern wherein there has been an accepted justification for the temporary trade restrictions under the WTO. Now, when WTO was into existence or came into picture, what happened? There was a certain justification that whenever you are dealing or transacting at the international trade, whenever the particular goods or services have been exported or imported, then the WTO has a certain right and authority to decide about the rules and regulations which have been forming or the part of the international or the global trade. But at this point of time, what happened? The intervention of the government of the domestic currency or the domestic market is essentially a requirement in order to control all the factors of production, to see that all the factors of production have been provided at a feasible rate. There is a proper control on all the components, and the business is conducted in a competitive market very fluently and effectively. Now, there are certain critical arguments to it. The critical arguments with respect to the economic intervention is economic intervention of infant industry argument is it is useless unless it makes the industry more efficient. So unless and until your domestic industry is efficient, you cannot make an argument, and the government cannot say that the industry is quite competitive and conducive to the growth perspective. If a country has the potential to develop a viable competitive position, its firms should be capable of raising the necessary funds. So at the same point of time, what we have to see that the proper availability of funds is available with the domestic firms, and they are having a competitive position in production or manufacturing of those goods and services which has been required and demanded by the consumers. So with respect to the demand of the consumers, we have to see that at a several point of time, whatever may be the requirement of goods and services, according to those requirements, the competitive position should be made available. The proper quantitative and quality supply of goods and services should be made available. And at every point of time, if a certain availability or the arrangement of funds is required to be maintained, then the availability of funds should also be maintained and created accordingly. Next perspective with respect to the strategic trade policy. There may be an important first mover advantage. So government can help firms from their countries attain these advantages. So manufacturer can produce in the same market, also you can go and produce those particular goods and services, and the same quality and quantity of goods and services can be available in competency to the international market, at the local market, at the domestic markets also. Second perspective with respect to the strategic trade policy is with respect to the government can help the firms to overcome the barriers to entry into Indian industries where foreign firms have an initial advantage. So with respect to the providing the supportive environment to the domestic manufacturers, the government can reduce the barriers that is available or applicable in the international market, and it can help for provider firm to provide an initial advantage at every point of time. So in this way, we can see that the strategic trade policy of the government is helping the domestic manufacturers, the domestic producers, and it is reducing the barriers to the international market also. So if the goods and services have been produced in an efficient way at the domestic market, the same goods can be exported to the different countries, and you can get a benefit out of it. Now, the revised case for the free trade. Now, why a particular free trade has been required, and what is the various differentiation between the traditional approach and the modern approach? So, new trade theories believe a government intervention in the national trade is being justified. So, at this point of time, as on today's scenario, what do we see? We say that there is a certain requirement of the intervention of the government, and the government has to intervene for various transactions that are into picture. So at every point of time, whether a transaction may be of either import nature or the export nature, at the international trade transactions, the intervention or the involvement of government is quite required. But the different classical trade theorists, they have disagreed and mentioned specifically that there is no requirement of the intervention of the government is not required. So new trade theories after the 2000 era or 1950s era, they have been saying that the government should positively intervene and control all the situations that have been coming into picture. The two situations where restrictions on trade may be inappropriate is in terms of the in terms of your domestic policies. So with respect to this particular concern, now let's see what is the concept of retaliation and what is the concept of domestic policies. The first perspective is with respect to the retaliation and war. So strategic trade policies aimed at establishing the domestic firm in a dominant position in a global industry, and beggar thy neighbor policies thus that boost the national income at the expense of the other country. So a country that attempts to use such policies will probably provoke retaliation. A trade war could leave both countries worse off. So at this point of time, what we can see, the retaliation situation is at a particular position wherein if the same quantity of goods and services is made available at two international markets or at two countries, then at this particular point of time, there can be a situation of trade war between those countries. For example, now I'll give an example for you. For example, manufacturing or production of iPhone. Now, if a particular iPhone needs to be manufactured, and whenever this particular iPhone is been demanded by a particular consumer, what happened? The same product, same quality, and same quantity of goods and services is being manufactured at India, and same is being manufactured at Sri Lanka or China. Now, when these particular goods and services have been manufactured at same quantity, same quality, same perspectives in two different countries, there is a trade war situation between those two countries, either to the export or import of goods and services. So at this point of time, when a particular import of goods and services needed to be done, or when Russia wants to import these particular goods and services in terms of the iPhone, what happened? There is a war situation. There is a war situation in terms of trade between India and Russia, and between India and China, or China and Sri Lanka, if all the countries are producing these particular goods and services. So retaliation in the sense, so availability of a dominant position at the global trade or the global industrial market situation is a particular concern wherein from which country the goods to be produced or from which country the goods to be manufactured or supplied. So in this way, there is a situation at this particular point of time, what we need to see, if there is a proper intervention of a government perspective, then at this particular point of time, the government can come forward and control the situation of the war situation of the trade war between the different countries that can arise. Second perspective is with respect to the domestic policies. The government can directly influence the domestic policies with the help of the special interests that can be created. So the government can come forward and provide a certain environment and a certain boost to a certain sector, to a certain industry, to a certain company, and in this way, it can create a balance with different transactions value or different manufacturing and production activities. So control on the domestic policy is utmost important requirement, and at this point of time, the government only can come forward and control all those particular transactions. A government's decision to intervene in a market may appease to a certain group, but not necessarily the support of interest to the government country as a whole. So at this point of time, what we need to understand, what we need to see, a support by the government, a support or the intervention of a government to a certain trade may be positive, but to a certain trade it may be negative. Now, for example, if the government intervention in steel and iron and steel industry is quite positive, wherein in the other case, the government may find the intervention, the consumers, the traders, the manufacturers can find the intervention of the government in telecom industry, in auto industry, or in certain other allied industries in a negative way. So wherever it has been required, there may be a certain concern wherein the intervention of the government may be positive in some sector or a certain group or a certain industry, whereas it may be negative in certain sector or in certain groups or in certain industry. So accordingly, as per the requirement, as per the support, as per the need of this particular concern, the interest of the country should be taken into consideration, and accordingly, the government should come forward and intervene in whichever sector it is being required. So intervention in all the sectors, all the industry is not at all required. So whenever it is been founded that the situation is of a certain situation, or if a particular situation may arise wherein a trade war situation can come forward, then at this particular point of time, the government needs to come forward and control all the factors of production that are into existence and the import and export of goods and services. Now, the function or the ruling system of the world trading system. Now, the development of the world trading system, how does it come into picture? So since World War II, an international trading framework has come into picture, and after World War II, World War II, every nation has come forward and they realized that there is no point in creating a certain environment wherein we are harming in each other, and we need to come forward and create a certain situation or a certain platform wherein each and every member country is being benefited with the international trade or with the help of import and export of goods and services. So for this particular concern, in the first 50 years, that is from post World War II, that is after 1940 onwards, the framework was known as GATT, that is the General Agreement on Trade and Tariff, or Tariff and Trade. So in this way, for the first 50 years, that is from 1940 to 1980 or 1990, there was a certain situation or a framework into picture, and that particular world trading system was called as an GATT. Now, after the 1980s, 1990s onwards, what happened? A new framework was been framed. There has a certain need that has been arised that the GATT policy, the General Agreement on Trade and Tariff, is a quite old perspectives, and we need to revise and create a new set of rules and regulations. So with this particular concern, in the year 1995 onwards, the framework has been known as WTO, that is World Trade Organization. So the extension to the GATT, revision to the GATT was being provided, and the new trading organization, new world trading system came into picture, and this new trading system was called as an WTO, that is World Trade Organization. From Smith to the Great Depression. Now, in the earlier situation, what we have seen, there were different trade theories from the Industrial Revolution perspective. Now, from the Industrial perspective, in the sense that is from 16th century, we have dealt with the different trade theories that was into existence. The first trade theory that was being proposed by Adam Smith from 16th and 17th century. The next theory that was being proposed by David Ricardo, which was applicable in the 17th and 18th century, and the Heckler-Ohlin factor endowment theory, which was applicable in the 19th century. Furthermore, we have come with the particular perspectives of the theory in respect to the 20th century with respect to the Heckler-Ohlin factor endowment, and another theories came forward. And at this particular point of time, in the year after the 1930s, whenever there was a situation of Great Depression, what we have seen, various countries came forward and they realized that in order to increase the international trade, in order to increase the import and export of goods and services, what happened? We need to come forward and create a certain situation wherein each and every member country, each and every nation has been benefited from the terms of international trade. So after the Great Depression of 1930, there came a certain situation of protectionism, wherein every country is looking for the protection of international interests, the protection of import and export of goods and services and transaction at the international level. So in the year 1930, the US has enacted the Smoot-Hawley Act, which has created a significant import tariff on foreign goods and services. So on importing a certain goods from foreign country or different countries, what happened? The Smoot-Hawley Act came into picture, and the US economy has for the first time imported a certain tax on goods and services for importing the goods and services. So same point of time, on looking for the Smoot-Hawley Act, the different nations, different countries come together, came forward, and they also have imposed certain tariffs, certain taxes on the import of goods and services on foreign goods that is into picture. So in this way, what we can see, the world has come together, the world have came together, and after the Great Depression, a new act, new pictures came into existence, and the act or the law has been revised accordingly as per the need and requirement of the world economy. Now the situation or the scenario from 1947 to 1979. So in this situation, there came the perspectives of GATT, that is General Agreement on Trade and Tariff. The trade liberalization came into picture, and the economic growth of the countries or the world trade started to increase. So after World War II of 1940, the US and the other nations realized the value of the free trade, and they established the General Agreement on Trade and Tariff in the year 1947. So GATT was established from 1945 to 1947, and the approach of GATT came into picture, wherein it was being provided as a multilateral agreement to liberalize the trade transactions. So multilateral agreement in the sense several countries can conduct the business transaction with several countries, and the goods and services can be exported and imported freely. So at this point of time, the gradual elimination for the barriers to the trade was taken into consideration, wherein it has been seen that there should be a minimal barriers for the international trade transactions. GATT membership grew from 19 to more than 120 member nations. So in the initial phase, in the initial establishment in the year 1945 to 47, only 19 countries were the membership or having the membership of GATT. But furthermore, up to year 1979, the countries has increased, the membership nations has been increased, and now as on today, we can see from 120 onwards, today the membership of GATT, that is WTO, is around 180 to 190 countries into existence. Tariff reduction was spread over the 8 rounds of the negotiation. So different rounds of negotiations came into picture, and after a certain negotiation that was came, the different rates of tariff was been revised, and the company started to exchange these goods and services while imposing a different amount of taxes that was being charged. the GATT regulation were enforced by a mutual monitoring system. So how this particular mutual monitoring system came into picture by preparing a certain rounds, by inviting the respective countries for discussion, and from a discussion perspective, the enforcement of mutual monetary systems came into picture. Now, the scenario of 1980 to 1993 is called as the protectionist trend theory. So in this way, every member country, every nation of GATT, every component or every participants of GATT was looking for only protecting the trade environment or protecting the world trade system. So the world trading system came under a certain strain during the 1980s and earlier 1990s because the Japanese economic was into a certain crisis. So the Japanese economic success strain has been more equal to the trading system. So at a certain point of time, what has been seen, only certain specific nations were getting benefited and other nations was not getting benefited out of it. The economy of Japan, the economy of Europe, the economy of US started to grow at a very faster rate and at a very higher rate. But the several economies which was at a very developing stage or underdeveloped economies, they were not getting benefited out of it. Why? Because there was a certain rules and regulations or restrictions in terms of GATT, which was not providing a balanced growth of environment. So with this way, what happened? Persistent trade deficits by the US caused significant problem in some industries and political problems for the government. So at this point of time, what happened? It was been observed that several sectors of the industry, several sectors of US started to grow at a very higher scale, but several sectors and industries of US and other developing nations was not developing at a very constant state. So in this way, what happened? Balanced growth and balanced development was not taken into consideration. So many countries has found at this particular point of time that the GATT is limited to the use of tariff and many other forms of intervention has not been taken into consideration. So GATT is not providing you a balanced growth, balanced development perspective. So there is a certain need. So at this particular point of time, the protectionist trend came into picture, and from 1990 onwards, the countries, the nation realized that we need to provide a protection and a protectionist environment to all the member countries or to all the nations as a whole. So there came a certain picture of the Uruguay round and the World Trade Organization. So in the year 1986, which specifically focused on the Uruguay round, so a particular discussion, a particular board members meeting of the all member nations was conducted at Uruguay, and several discussion on certain points that was being conducted focused on the number one perspective is with respect to the services and intellectual property. So the services now earlier GATT was been specifically focusing on only goods and the services was not taken into consideration. But now in the year 1986 in the Uruguay round of a roundtable conference, what happened? The services perspective also came into picture and a discussion on intellectual property was also of a certain concern. So agriculture was given a certain emphasis and the discussion on services, the discussion on intellectual property, transaction with respect to the patent, trademark, copyrights came into picture, and the thrust on the agriculture, goods and services was also taken into consideration. With this particular concern, the WTO need came into picture, and the WTO was established as a more effective policeman, which can look forward for all the transaction activities and which can control the global trade business activity transactions. Then, furthermore, the GATT, that is GATS and TRIPS, was established and performed at this particular point of time, wherein it is known as General Agreement on Trade in Services and Trade Agreement on Trade-related aspects of intellectual property rights and international management service. So TRIPS and TRIMS came into picture, and GATS, GATS, that is General Agreement on Trade in Services, was separately established. Another perspective that you can see here is the future of WTO, and which was been unresolved in the Doha round. So again, after the Uruguay round, the second round of discussion was been conducted at Doha, and it is called as a Doha conference. So in this Doha conference, the WTO is currently now they are focusing on the various aspects with respect to the anti-dumping policy, with respect to the protection given that is needed to be given or provided for the agriculture, protecting the intellectual property with respect to the patent, trademark and copyrights, market access for non-agricultural goods and services that are into existence, and the new extension for the rounds of talks that has been conducted at Doha. So Doha is an extension to the Uruguay round that has been conducted for the protection of services and protection of intellectual property. So additional involvement of WTO was provided at this particular point of time. implications of for the different managers. So why should international managers should care about the political economy of free trade or about the relative merits of argument for the trade and protection? So this is a question that is raised for you. So why you as a manager should look for the international protectionism trade theory? So in order to reduce the trade barrier that is impacting the firm strategy, you have to come forward and see that the political economy is quite stable, the environment is quite stable, a proper conducive environment with respect to the trade theory it is being provided, the trade and services are traded freely, and the goods and services are being freely imported and exported at the international level. Second perspective for promoting the trade or the at the global level, domestic level, and international level also needs to be taken into consideration, and it is also needed to be seen that the trade barriers are reduced effectively and simultaneously. Now, the trade barriers and the firm strategy can be with respect to the raising of the cost of exporting, the limit of the quotas or the export limits that has been raised. So the quota can be either for the import or for the exports. The quotas can be in terms of quantitative and qualitative terms. The quotas can be in terms of your valuation perspectives also. So another perspective, the firm may have to locate the production activities within a country to meet the local content regulations. So LCR, that is local content requirement, specifically focuses on a particular concern wherein you have to focus, you have to give a certain perspectives with respect to the availing of facilities for only those transactions wherein it is benefiting the local economy, it is benefiting the local transactions at every point of time. The trust to the future trade barriers can also be influenced the firm's strategy. So the threat to the future trade barriers in the sense that is at the international market or the global market, you can identify, you can see that whenever you are going for international market, there may be a certain situation that the product or the environment may be acceptable or it may not be acceptable. So according to the global requirement, according to the requirement of the international market or the global market, the product should be made available and accordingly the goods and services should be supplied. So whatever the goods and services that is made available at the international market, the same product should be available in the domestic market. And in order to make the manufacturing or availability of the product at the domestic market, the government should look for reducing of all those trade barriers. The trade barriers with respect to the intervention of the government, with respect to the costing of the product, with respect to the supportive environment for the local content requirement, with respect to the voluntary export restraint, with respect to the quotas, with respect to the availability of goods and services and feasibility of production facilities and so on. Everything needed to be taken into consideration and the firm strategy must be designed accordingly. On a last perspective, with respect to the raising of cost of capital and the raising of cost of goods and services. So whatever the cost of goods and services is made available, it should be quite competitive in the national picture or the international picture. So if any product is made available at a certain price in the Indian market, the same product should be made competitive at the world market or at the global market. If a particular product is available at the global market at a certain price, the same competitive price should be provided at the domestic market in Indian terms currencies also. So in this way, the trade theory, which has been designed, that has been provided by the Adam Smith, David Ricardo, Heckler Rollin, and Factor Endowment, it should be provided a certain position and a certain feasibility that it should be matched. The proper international environment conditions should be quite suitable, and it should benefit all the manufacturers and all the supplies at the larger scale. Now let's look at the perspectives of the policy implications. Now, with respect to the policy implications, what we need to see, the international firms must have an incentive to lobby for the free trade and keep protection process for causing them to change the respective strategies. So there should be not a certain situation that a proper lobby or a lobby situation has been created and a free trade cannot be conducted. So all the free trade activities must be conducted at the international level and at the domestic level. And the strategies of the government, the strategies of the firm, the strategies of the company needed to be changed accordingly as per the need and requirement of the international market. While there may be short-run benefit to a firm, the government protection in some situation in the long run and in the short run is always needed to be required. So there should not be a situation that the government intervention in the long run is being required, but in short run we are ignoring these particular factors of production. So at this particular point of time, the proper intervention, proper protection of the government is also required, wherein if it is required in short run also and if it is required in the long term also, so proper involvement of the government should be made at every point of time. The government can retaliate, making it more difficult to construct a globally dispersed production system. So, if at any point of time it is been felt that there is no involvement of the government, then the proper conducive environment should be seen, and we should not see that the over involvement of the government or under involvement of the government is not backfiring the particular economy and is not creating a certain situation wherein the government is either benefiting the international market or the government is not benefiting the international market. So simultaneously, the government should see that it is benefiting the domestic manufacturer, domestic producers, and it is also benefiting and providing the platform for producing or supplying your goods and services at the international market situation also. So in this way, in today's lecture, we have seen with respect to the different trade theories that are brought into existence, the various instruments to the trade policies, why there is a need of the intervention of the government, and what are the implications of the WTO and IMF and the GATT into perspectives, wherein it has been seen that the implications of the government intervention, the implications to the manager, the implications to the trade barriers, and the Uruguay and Doha rounds of conferences with respect to GATT and WTO. Thank you so much, everyone, for your patience listening and your attendance. Thank you.